Okay, so someone hands you a car wash. Not a bucket and a hose in your driveway, the real thing. Cars rolling through a tunnel of foam and spinning brushes, water streaming off freshly waxed paint, a line of vehicles stretching out to the street on a sunny Saturday. It's the classic passive income fantasy that business people joke about wanting to own because it feels almost too simple. Cars get dirty. Cars need to get clean. You just stand there and collect the money while the machine does the work. It is not that simple. Owning a car wash is a genuinely capital-intensive, mechanically demanding, and increasingly consolidated business, because underneath that simple pitch sits a real estate play, a water utility problem, and a subscription business all running at the same time, and getting any one of those three wrong can sink a location that looks, from the street, exactly like the profitable one next door. There are car wash operators who've built genuine regional empires worth tens of millions of dollars. And there are owners who built a beautiful new tunnel, watched a competitor open 2 miles away offering a cheaper membership, and spent the next 3 years fighting a price war that neither location could actually win. Here's the thing about this business. The wash itself is almost never the hardest part to get right. Let's be clear about what you're actually buying, because car wash covers several very different business models with wildly different economics. A self-service car wash, the kind with individual bays where customers spray their own vehicle with a coin-operated wand, requires minimal staffing and modest capital but generates correspondingly modest revenue per location. An in-bay automatic, the single-vehicle rollover machine you might remember from a gas station, sits in the middle in terms of both cost and revenue. A full-service tunnel wash, the kind with a conveyor system moving the car through automated equipment while staff hand-dry and detail the interior, is a genuinely labor-intensive operation with meaningfully higher revenue per car but a much heavier payroll. And the express exterior tunnel, a conveyor-based wash with no interior service and minimal staffing, built specifically around a monthly unlimited membership product, is the fastest-growing and most heavily capitalized category in the entire industry today, and it's the model this script focuses on primarily, because it's the version private equity and institutional capital have been pouring money into for the past decade. Let's talk about what it actually costs to build one. A modern express exterior tunnel location, including land, building construction, and the wash tunnel equipment itself, conveyor system, brushes, dryers, water reclamation equipment, can run anywhere from $2.5 to $5 million depending on the market, with the tunnel equipment alone frequently representing $700,000 to $1.5 million of that total. Land cost is a genuinely critical variable here in a way that's easy to underestimate, because an express wash lives or dies on traffic count and visibility, meaning the best sites, high-traffic corners on major commercial corridors, command real estate prices that reflect their value to every other retail use competing for that same location, not just car washes. A self-service or in-bay automatic location is dramatically cheaper to build, often somewhere in the $150,000 to $400,000 range per site, which is exactly why that category remains the entry point for smaller independent operators even as the express tunnel category consolidates around better capitalized regional and national players. Before you open the doors, you also need infrastructure that most customers never think about at all. Water reclamation and recycling systems have become close to mandatory in most jurisdictions, both for cost control and increasingly for regulatory compliance, and a comprehensive reverse osmosis and water reuse system that lets a wash recycle 60 to 80% of its water rather than pulling fresh water for every single car can add hundreds of thousands of dollars to a project on its own. Wastewater discharge permitting is its own regulatory hurdle, because a car wash generates wastewater containing oil, chemicals, and road grime that can't simply be released into a standard storm drain, requiring pretreatment infrastructure and ongoing compliance monitoring with local water authorities. Vacuum stations, increasingly expected as a free amenity at express locations to keep customers loyal, require their own dedicated equipment and paved space, adding real cost to the site plan that has nothing to do with the wash tunnel itself. And membership technology, the license plate recognition cameras, the RFID tag readers, and the billing software that runs the entire subscription model, is a genuinely significant and continuously updating technology investment, because the membership system isn't a side feature at a modern express wash, it's the actual engine of the business. Now let's talk about what it costs to run the thing every single day, because a car wash's operating costs break down into a few categories that look nothing like most retail businesses. Water and sewer costs are a constant, variable expense directly tied to volume, and in water-stressed regions or municipalities with tiered commercial water rates, this line item can swing meaningfully based on both weather and local utility policy in ways an operator has very little control over. Chemical costs, the soaps, waxes, and specialty treatments that make up the actual wash experience, are a real and recurring supply cost, though a genuinely smaller share of total expense than most people assume. Labor is smaller than you'd expect at an express tunnel specifically, since the entire model is built around minimizing staff, typically just a handful of greeters and vacuum area attendants per shift, but labor climbs substantially at full-service locations that still hand-dry and detail every vehicle. Equipment maintenance is the category that surprises new operators most, because a conveyor system running hundreds of cars a day puts real mechanical wear on brushes, belts, dryers, and pumps, and a tunnel sitting down for repairs during a busy Saturday isn't just a maintenance cost, it's a direct hit to that day's revenue with no way to make it up later. Here's where the revenue model gets genuinely interesting, because like several other industries covered in this series, it has been transformed by a shift toward subscription revenue. For most of the industry's history, car wash sold individual washes, priced per visit, with revenue rising and falling directly with daily traffic and weather. Today, the dominant strategy at express tunnel locations is the unlimited monthly membership, typically priced somewhere in the $25 to $45 range depending on the market and wash tier, which converts unpredictable per-visit revenue into a large pool of recurring monthly billing collected automatically regardless of whether a given member actually visits that month at all. This changes the entire mathematics of the business, because the average member doesn't wash their car anywhere near as often as the unlimited pricing might suggest, meaning a meaningful share of membership revenue effectively comes from members who signed up with good intentions and then simply forgot to cancel, the same underlying economics that make gym memberships profitable. A well-run location with strong membership penetration can generate remarkably stable, weather-resistant monthly revenue compared to a pure paper wash competitor, because a member who's already paying whether they show up or not has far less reason to skip a rainy week the way a one-time customer would. But here's the trap sitting underneath this entire growth story, and it's the single most important structural risk in the modern express wash business. Because the membership model is so attractive and the unit economics of a single successful location can look so good, the industry has attracted an enormous amount of capital over the past decade, and in many fast-growing suburban corridors, that capital has built far more express tunnel capacity than the local population can actually support. When 2 or 3 express washes open within a few miles of each other, all competing for the same pool of potential members, the natural competitive response is to cut the monthly membership price, and once one operator in a trade area drops their price to win members away from a competitor, the others typically have to match it or watch their own membership base erode, triggering exactly the kind of margin-compressing price war that can turn a well-built, well-located wash into a marginal business almost overnight, regardless of how good the equipment or the wash quality actually is. Let's build the 2 honest scenarios. In a good year, a location in an underserved trade area builds strong membership penetration relative to its local population, churn stays low because there's no aggressive nearby competitor undercutting price, and traffic counts support consistent daily car volume even through weather swings because enough of the revenue is already locked into recurring membership billing. A well-run express tunnel location in a strong, uncontested market might generate healthy operating margins once water, chemicals, labor, and equipment maintenance are covered, producing real distributable cash flow well above what the site's debt service requires. In a bad year, a new competitor opens nearby and triggers a membership price war, churn climbs as price-sensitive members jump to the cheaper option, and because the fixed costs of the location, the mortgage or lease, the equipment financing, the base staffing level, don't meaningfully shrink just because membership revenue is eroding, a location that looked like a reliable cash-flowing asset a year earlier can turn into a genuinely troubled property surprisingly quickly. The clearest real-world illustration of how this industry has actually evolved is the story of Mr. Car Wash, one of the largest express and full-service wash operators in the country, which grew from a regional operator into a national chain largely through an aggressive, debt-financed acquisition strategy, buying up independent car washes across the country and converting many of them to the membership model, before going public on the New York Stock Exchange in 2021. That consolidation strategy mirrors almost exactly the same debt-financed roll-up pattern we've seen collapse spectacularly in other industries throughout this series, and it captures the core tension of the modern car wash business perfectly, the membership model genuinely does produce more stable, more valuable revenue than the old paper wash approach, which is exactly why sophisticated capital has poured into the sector. But that same wave of capital has also built enough new tunnel capacity in some markets to trigger the price wars that threaten the very stability the membership model was supposed to provide in the first place. The industry's own trade data has repeatedly flagged overbuilding in specific fast-growing metro corridors as a genuine risk to unit-level economics, even as the broader membership-driven growth story continues expanding nationally. Now here's the twist that explains why sophisticated real estate investors have become just as interested in this industry as the operators actually running the wash equipment. Car wash real estate, specifically the land and building underneath a well-performing express tunnel location, has become one of the more sought-after categories in the net lease real estate investment world over the past several years, with specialized investors and REITs actively buying the physical property beneath operating car washes and leasing it back to the operator on a long-term, triple net lease, the same real estate versus operations split we've now seen show up across casinos, hotels, data centers, and ski resorts throughout this series. This sale-leaseback structure lets an operator free up the capital tied up in real estate to fund faster expansion into new locations, while the real estate investor collects a long-term, contractual stable rental income stream that's largely insulated from whether that specific location wins or loses its local membership price war, because the lease payment is owed regardless of how many members that particular tunnel actually has this month. For the operator, the wash equipment and the membership base are the volatile, competitive part of the business. For the real estate owner, the corner lot with excellent traffic visibility was always going to be valuable, whether the car wash on it thrives, struggles, or eventually gets replaced by another retail use entirely. What separates the car wash operators who build lasting regional businesses from the ones who get caught in a ruinous membership price war is almost never the quality of the equipment or the wash itself, since most modern tunnels use broadly similar technology from a handful of major manufacturers. What actually determines the outcome is whether the location was built in a trade area that can genuinely support it without inviting immediate oversaturation, whether membership pricing was set sustainably rather than as an aggressive land grab that a competitor can simply undercut, and whether the underlying real estate itself, regardless of how the wash business performs, was valuable enough to protect the ownership group's downside no matter what happens to the membership numbers. The cars will keep getting dirty, and people will keep paying to get them clean. Whether the specific tunnel you built is the one still standing, profitably, 5 years from now depends on a lot more than how good the foam looks coming out of the nozzle.